I have 2 o'clock on my phone, so I'll just kick it off and then I'll get over to you for you to start your presentation. So thank you to all who have signed in and called in to this call today. We're very excited to be doing this call in partnership with Ernst Young. And today, Ray Beeman, who is a principal and co-leader at the Washington Council of Ernst Young, will be giving an overview of the tax credits that have come down in the 2 latest federal bills. So I won't say much more. Ray, I'll turn it over to you.
Great. Thanks, Sarah. Good afternoon, everyone. Hope, first of all, everybody's doing well and staying safe. I know the peak is in different places at different times, and I haven't really been able to check on South Carolina lately, but here in Washington area, we're expecting the peak in June, so we're going to be hunkered down probably for a while up here. So I just want to say good luck down there to everybody. I've been asked to talk about the federal government's response to the coronavirus crisis. And as everybody well knows, it's first and foremost a health crisis, but also turning rapidly into an economic crisis. And the government has really had 3 big responses to what has transpired. The first one really at the outset, the beginning of March, at the outset of real changes in everybody's activities, was what is now a relatively small appropriations bill, about $8 billion directly towards the healthcare response, the immediate response to COVID-19. A couple weeks later, that was followed by a second bill, which is about $100 billion. So you're seeing a pattern here. And that was really focused on dealing with small businesses that had workers who had either had to stay home because they were sick, they had a relative who was sick, they had a child who was home because their schools closed. And so that bill did really 2 main things. First, it extended the Family Medical Leave Act periods to provide for extended sick leave, as well as extended paid family leave. And I think there's like 5 different scenarios where somebody would qualify for that. And then for companies who have employees in those categories who were on leave, the bill provided employee retention tax credits, or really just employee tax credits, to compensate for providing this paid leave. And it was a tax credit against payroll taxes, refundable. And so it was designed to really kind of try to ease the pain of small businesses losing their employees. It was limited to companies under 500 employees. And so that led to the CARES Act, which was enacted 2 weeks ago tomorrow, a vastly bigger bill than the first 2 and much more wide-ranging. That bill is over $2 trillion, and with money going into the Fed programs, would allow the Fed actually to lever up that amount up to upwards of $4 trillion. And literally this morning, we saw the first major action that the Fed took along those lines. We'll get into that in a moment. So, really the starting place for the CARES Act is to focus on what the 2 guiding principles of Congress were in putting that bill together. They had any number of requests being brought in by the business community all over the place, tax, non-tax. But everything that's in the CARES Act is really around 2 principles. One is providing immediate cash liquidity to the economy as it started to shut down intentionally to deal with COVID-19. And also employee retention. Obviously, companies can't operate, workers can't come to work. Without any action, we did see obviously significant layoffs in the unemployment numbers, but probably even worse than that. And so those are really the 2 big areas. I like to say Congress has 3 levers, and they pulled all 3 here in this case: spending, lending, and taxes. And so I've kind of divided the bill up into those 3 pieces. And as we kind of go through them, I'll also kind of focus on what has transpired in the last couple of weeks in implementing the CARES Act and some of the issues that have cropped up in trying to activate these provisions. So on the spending side, I guess the biggest news there was unemployment insurance increase and extension. So unemployment insurance period was extended by 13 weeks. It also allowed states to provide unemployment insurance in the first week after an employee is laid off, which is not typically the case. And it also increased the amount of the benefit by $600. And as a side note, the Senate delegation from South Carolina raised some objections around the increased level because in some cases, with that $600 increase, it could actually lead to workers who are earning more on unemployment than working. That didn't prevent the bill from going through, but that was sort of a last minute wrinkle from Senator Scott and Senator Graham. So kind of interesting to be talking to you all today around that issue. And so the spending side really was, like I said, unemployment insurance, $350 billion for state and local aid. And what's important to point out there is that unlike the federal government that can kind of spend relatively unlimited amounts, go into debt, deficits, borrow money, states are much more limited in their capacity. So they're really relying on the federal government to help get them through this crisis fiscally. There was also a significant amount for the healthcare system. The $8 billion in the first bill was kind of dwarfed by the $150 billion that was provided for the healthcare system. In the CARES Act, there was also a number of policy changes designed around the COVID-19 response with regard to teleworking and various things like that. So a lot going on healthcare-wise in that bill. And so that was a significant portion of the bill is the spending. On the lending side, there's really two main programs. I think probably a lot of you have already seen this be implemented on the ground or maybe not implemented quite yet. There's the Payroll Protection Program, which is the SBA loan program. Congress allocated $350 billion to that program to go out to small businesses. These are businesses that are under 500 employees. And one issue around that program, some of you might be familiar with, is there's an affiliation rule in terms of counting how many employees you have for the 500 employee limit. It's very broad. So, really, unless you're a true standalone business that has under 500 employees, or you're in a group of businesses that have total under 500 employees, it's operated to really limit the program to a lot of companies who in various locations have less than 500 employees, but overall have more. Couple exceptions to that. One, if you're in certain industries like food or lodging, you're allowed to count that limit location by location. So that's a very important expansion of that limit. Also, franchises can count location by location as well. And it's not limited to, standalone C corporation companies. It also can apply to self-employed businesses, sole proprietorships, independent contractors, nonprofits. So in terms of the types of operations that can apply to it, it's quite broad. That program actually went live last Friday, or sort of went live last Friday. There's been a number of operational glitches in terms of the bank's ability to process loans. Guidance is literally coming out as this thing is going live. The actual application went out fairly late for people to apply. There's some hesitancy among the banks around their liability in case a borrower provides erroneous information in terms of their eligibility. And so the banks have been a little hesitant. The Treasury Department and SBA have issued two pieces of guidance that, among other things, attempt to sort of hold the banks harmless if it turns out a borrower really wasn't eligible, and puts it back on the borrower to provide accurate records. So that program is lifting off the ground, if you will. I think already $70 billion or so has gone out the door. And another aspect of the program is that the loan is forgiven as the proceeds of the loan are spent on payroll costs and other expenses. So the maximum amount you can borrow is $10 million, but the maximum amount or the amount that you're actually eligible to borrow is based on 2.5 times your payroll costs. So in many cases, it's less than $10 million. And as I said, it gets forgiven as you spend down your payroll costs over the next 8 weeks. There's no tax on that loan forgiveness. That's also a tax feature in the CARES Act. And so we're seeing, that money start to go out the door. Very important point to make, I'll get to the tax stuff a little later, is that anybody who takes out an SBA loan under this program is not eligible to claim the employee retention credits that are also provided in the CARES Act. So really you have to do sort of a either or analysis. Are you better off getting the loan? Do you get more from that? Are the terms of it, the forgiveness of it better? Or are you better off not taking out the SBA loan and claiming the employee retention tax credits? And that's a very case-by-case situation. We've had some situations where it's better to take the loan. Others, it's better to get the employee credits. And it's not just a numbers game either. There's certain aspects of the SBA program that might be more or less beneficial. There's a concern that that $350 billion will go pretty quickly. So literally this morning in the Senate, there was an effort by Republican leader McConnell to add another $150 billion to the program. The Democrats countered with their own request for $250 billion for more health care and state and local aid. And so there's currently a negotiation happening to see if they can actually inject more money into the CARES Act, particularly on the SBA loan program. And kind of we'll see how that plays out over the next several days. Of course, Congress is not in session. The Senate is only meeting in a pro forma session. So there's some practicalities around Congress actually doing anything right now, since the members are generally out of town. But it really limits their ability to operate. They either have to get something through by unanimous consent or perhaps change the rules to allow for remote voting. So those are discussions that are currently happening in Washington. So we'll see how that plays out. But on the ground, the SBA loan program is out there. It's operating. The financial institutions that are authorized to make the loans are trying to process them. We understand there's a number of glitches around the paperwork that's coming in. So, but as with any big program, that's kind of to be expected. The second piece is the Economic Stabilization Fund. So this is the part of the bill that really allows the Fed to provide up to $4 trillion or more, even in financial assistance. And unlike the SBA loan program, it's not limited to any particular size of company. It could be largest multinational companies, or it could be mid-sized companies. And in fact, the Fed this morning came out with an announcement that is set up a facility to push out $2.3 trillion in aid. And the centerpiece of that really is this so-called Main Street lending program. Part of that $2.3 trillion, which is $600 billion towards this program. And this is for companies that maybe are too big for the SBA program for 500 employees, but they are under 10,000 employees. The real downside to the Economic Stabilization Fund that was built into the CARES Act are that it comes with a number of restrictions. So if you take out any loan from this particular part of the CARES Act, there are limitations on the ability to issue dividends, stock buybacks, employee compensation restrictions. And then in particular, if you're in this Main Street lending program, there are further limits around employee retention, keeping employees in the U.S., and also some union labor type restrictions in there as well. So, anecdotally, we're kind of hearing that those restrictions are so onerous that for a lot of companies, this is sort of the last resort play during this crisis. They really don't want to impose those kinds of restrictions on themselves if they can at all avoid it. So that's really the two big lending provisions in the CARES Act. Like I said, they're both being stood up as we speak, and there's every effort in the government to try to get these things moving as fast as they can. So the third piece is the tax piece. I'm a tax person, so this is much more my sandbox than the first two pieces. And the CARES Act includes about $590 billion of tax relief for both individuals and for businesses. On the individual side, the biggest provision is clearly the recovery rebate checks that are being sent out by the Treasury Department to every individual in the country under a certain income level. The checks are in the amount of $1,200 per individual, an additional $500 per child. If you have a bank account already on file with the IRS and you've already been getting your refunds through a direct deposit, those checks will go out in that way. There's other taxpayers who either don't file tax returns or they've changed their bank account or moved, where it's going to take a little bit longer. But those checks should be going out the door in around the next 2 weeks, according to the Treasury Department. Other individual side provisions, there are expansions of the charitable contribution deduction for both individuals and companies that increase the percentage limitations on the deduction and also provide individuals provide them an above the line deduction for as much as $300. There's also a number of retirement fund plan relief provisions. So people in these times often need to draw down their IRA, and normally that would come with penalties. The CARES Act waives those penalties for anybody who draws down up to $100,000 from an IRA or other qualified plan, and also allows any income taxes associated with that withdrawal to be spread out over 3 years. In addition, it allows individuals who have withdrawn money to recontribute any amounts they want to over the next 3 years without taking into account the normal caps that it would apply. Conversely, if you are over 72 and you're currently required to withdraw money from your IRA under the required minimum distribution, that requirement temporarily. So a lot in the charitable space as well. For companies that provide student loan repayment programs to their employees, the bill also would suspend any income taxes that would normally be owed by the employee for having their student loans repaid by their employer, I think up to $5,250, if I recall. So that's the individual side of the CARES tax package. The business side has a number of provisions. And I think when you're thinking about, well, why did they pick this particular relief over something else they might have done? Why is it, you would have thought there might be more tax relief in there. Really going back to the two principles of these tax provisions reflect the two things, which are immediate cash liquidity, as well as worker retention incentives. So on the worker retention side, the bill has what I'll call a payroll tax relief mini package, and it's two provisions. And this is really the area where we're getting a lot of questions about how this is supposed to work. And I'll once again remind everyone that the connection between these two provisions and the SBA loan program. Again, if you take out an SBA loan, you cannot claim the employee retention tax credits. In addition, if you take out an SBA loan, once it is forgiven, you can no longer defer payroll taxes under the bill. So the payroll tax relief provision has these two components. One, employee retention credit. This is available to companies regardless of size who have either experienced a 50% decline in revenues from last year to this year, this quarter last year to this quarter this year, or subsequent quarters, or you have had a partial or complete shutdown of operations, suspension of operations because of a government mandated shutdown. So one of those two requirements will get you into the employee retention tax credit. How much is the employee retention tax credit? It's up to 50% of $10,000 per employee. So it's a $10,000 cap on each employee's salary. And you get half of that, $55,000 in a credit. A lot of gray area around what does it mean to have your operation suspended. So there's obvious situations where this applies or doesn't apply. If you've got employees, if you're in retail and they're working in stores and you've had to close your business because of a government ordered shutdown, clearly that employee's probably not working, or a factory, same kind of thing. On the other end, if you have employees who have been already teleworking, so they really are kind of doing now what they were doing before, they're pretty clearly not going to be eligible. But for a lot of the employee base, maybe they're working from home, whereas they'd otherwise be in an office, but they're not working an entire day. They're not as productive. They're doing things that maybe aren't directly related to their traditional jobs. They're doing more training. There's a lot of uncertainty around whether those employees qualify, to what extent. We're hoping the IRS, maybe even as early as tomorrow, will put out a FAQ, frequently asked questions document that would provide a little bit of guidance in that area. So we expect to hopefully get a little bit more clarity about how that credit is supposed to work. Then there's the payroll tax deferral provision. Again, applicable to everybody and really doesn't have any of the restrictions the credit has. It essentially allows companies to defer the employer's share of Social Security taxes, the 6.2% employer's share, for the rest of the year. So that has already been underway with companies. It literally took effect last week. So companies are already deferring, as I'm sure you are, your payroll taxes, the 6.2% through the end of the year. All deferred payroll taxes this year will be payable at the end of 2021, 50% of it at the end of 2021, and then the other 50% at the end of 2022. That, the only issue really there is a lot of people use outside payroll providers, and some of them haven't yet adjusted their systems to allow you to not pay over those taxes yet. So there's sort of a practical implementation thing there that's getting probably worked out by those payroll providers. The two provisions I just described really are designed to work together because first and foremost, you're deferring your payroll taxes at the outset, but you're also getting this credit, which is refundable. So the way they work together is, if you have deferred your payroll, your 6.2%, you can claim the credit each quarter, but you can also apply it towards other payroll taxes. So it's an even more immediate benefit than an end of the quarter credit that you would normally get. So the reduction in the payroll taxes that you're actually paying because of the deferral will potentially trigger more cash through the credit mechanism. And again, I keep reminding people, be very careful about going to the bank and getting an SBA loan because it will impact your eligibility for those credits. So that's the one that I think has gotten the most attention so far, the most questions around it and how it's supposed to work. It's happening already. People are already deferring and will be getting their credits pretty soon. The other big one that probably has generated the most discussion is the NOL, the net operating loss carryback reinstatement. So the 2017 tax bill, the Tax Cuts and Jobs Act, changed the NOL carryback rules so that you can no longer carry NOLs back for 2 years, but you were able to carry them forward indefinitely. The CARES Act reinstates not only the carryback rules, but it also allows you to carry them back for 5 years for 2018, 2019, and 2020. It also undid another provision in the TCJ that imposed a 20% haircut on NOLs carry forwards, which required you to only allowed you to claim NOLs up to 80% of your taxable income. So temporarily for the next couple of years, you can apply them to 100% of taxable income. Two big complicated areas around this provision. One is as you're carrying these NOLs back, it will interact with other tax attributes that you might have, particularly on the international side, but even not on the international side. So a good example is if you were to carry back an NOL, let's say from even 2020, any of the years really back beyond 2017, we still have the Section 199 production deduction that was limited to taxable income. You could have a negative interaction between the NOL you're carrying back and that deduction you might have originally claimed there. So A lot of complicated modeling around the impact of carrying an NOL back potentially, and something to be careful about if you're going to carry an NOL back. The other real area that we're hearing about is just the practical question of how quickly can we get a refund under the NOL carryback provision. So there's really two ways to claim a refund on an NOL. One is the so-called quickie refund procedure, where once you file the appropriate form for that, you'll get the check right away, and the whole IRS review process that would normally take place happens after the refund comes to you. And then the other way is a more normal amended tax return that will take longer to get your refund check, because it has to go through the whole internal IRS process. The problem right now is that all IRS service centers are closed. Employees are working from home. They're not as productive. They don't have the total ability to process paper forms. And so currently the IRS is trying to get some kind of workaround for that process to get the money out the door more quickly. And that guidance could be coming as soon as the next several days, we hope. Another provision in the CARES Act allows companies who have AMT credits to claim them immediately. So again, going back to the 2017 tax bill, and there's a theme here on the CARES Act. A lot of these business tax provisions really involved undoing things that were done in the 2017 bill, like the NOL provision. But in 2017, Congress repealed the corporate AMT, and then also allowed companies who had AMT credits to have them refunded over the next few years. There's still, I think, one more year in that window, and the CARES Act accelerated that so that anybody with AMT credits can claim them immediately. Another big provision in the CARES Act involves the interest expense limitation. So again, in 2017, Congress limited the ability to claim interest expense deductions to 30% of EBITDA, and which would tighten in a few years. And what the CARES Act did was take that 30% deduction for 19 and 20, increase it to 50%. So a little bit more headroom there on the interest deduction. And because it's a percentage of your income, that is EBITDA, what the CARES Act also does is allows you for 2020 to apply your 2019 EBITDA under the assumption that a lot of companies in 2020 will have much less income, and so that ceiling would be much lower than people would like. So that even with the 50% increase, it might negate the relief provided in the CARES Act as well. Another provision in the CARES Act would actually fix permanently a drafting error in the 2017 bill around leasehold improvements. So in 2017, Congress intended for leasehold improvements to be fully deductible through the next few years, and through a drafting error, didn't cover leasehold improvements. That was fixed in the CARES Act. And you might ask, well, why did they do that after several years now of debating, whether to do fixes to the 2017 tax bill? Again, the thinking was, if you fix this for 18, 19, and going forward, that's another item that could trigger the ability to claim refunds back to 18 and 19. So if you haven't filed 19, at least for 18. So again, the thought being, fixing this actually triggers more cash liquidity in the system. And so that was done as well. So that kind of rounds out the business tax package, and really the overall tax package as well. There's a lot of items that Congress considered for the CARES Act that sort of didn't meet that litmus test of liquidity or worker retention. And we expect that Congress will be returning to legislating around the coronavirus situation. And we don't know how many more waves of legislation we'll be getting, but we do know we're probably going to get at least a couple more bills that are roughly similar in size to the CARES Act. Don't exactly know what the timing is of all that, particularly given that DC is more or less shut down for the time being. But as I said, right now, there is legislation that they are negotiating to actually increase the funding for the SBA loan program, as well as maybe healthcare and state and local governments. There's almost as soon as the CARES Act was enacted, the congressional leadership was already talking about doing a fourth response to COVID-19. And the timing of that is still believed to be late April, probably more likely early May. So Congress is scheduled to come back to Washington April 20th. I think most of us here in Washington think that's pretty optimistic given the situation on the ground. It's probably early May at the earliest. So that's probably the time frame where we would be potentially looking at another type of CARES Act response. And a lot of that will depend on the impact that the CARES Act has or hasn't had on the economic crisis we're experiencing. So TBD on what exactly that'll include. And when the fourth bill was first being discussed, I think Republicans and Democrats were in pretty different places. So Republicans were more interested in kind of hitting the pause button and sort of letting the CARES Act work in the economy. Democrats were already pivoting to other priorities like infrastructure, for example. Even the president talked about infrastructure, some other things that maybe are more long-term priorities of Democrats. I think over the last week, it's fair to say, as we've seen the things play out with the SBA loan program and other things, that there's more consensus that at least the next move in Washington should be to actually provide more funding for the CARES Act. And like I said, we could very well see that happen next week. But that doesn't really replace the idea that we're going to be looking at a fourth bill, like I said, in May probably. A lot of it will probably build off of the CARES Act. Maybe there might be just more money. Maybe there will be policy changes, whether we'll see more tax. There was a lot of controversy around doing business tax provisions in the CARES bill because particularly on the Democratic side, they were more focused on, the healthcare side of things and the individual side of things. And so I think there's some sensitivity about doing a lot more corporate related provisions, but that's not to say there won't be anything. I think probably there will be, because it'll be a really big bill. So there'll probably be room to do some things in that bill, but that really remains to be seen how that plays out. And I'm looking at this as kind of an evolution where, really these first three bills that were enacted are sort of the fire department showing up to put water on the fire. The immediate needs of cash and worker retention will probably move into a phase as this plays out of recovery and stimulus to try to get the economy, back up and running when the healthcare part of this event has passed. And then in all likelihood down the road, we're looking at sort of a reform type approach, maybe looking back at what all will transpire over the next several months and more lasting changes. I also think these first three bills don't reflect real visibility into the very specific sort of sector-based impacts of what we're experiencing right now. And I think part of it is we just have to sort of let it play out and see where things stand. Obviously, airlines right out of the box are immediately impacted. So part of that economic stimulus fund was actually carved out for airlines and air cargo carriers. So we knew that right out of the box that relief had to go there. But, not a lot specifically designated for, let's say, retail or hotels, which have been really hit hard already in hospitality in general. So, we could very well see in the next several weeks, as we get to this fourth response, more specific relief in those areas as Congress really understands better what is needed. There's probably going to be a lot around debt. Probably have a lot of foreclosures and debt restructurings. Those also create different tax issues. So we'll get a lot of granularity around what needs to happen. going forward, and we'll see, where Congress takes things past next week. The other thing I wanted to really highlight, we have this legislation that we've been focusing on, but administrative steps already were taken even before the first bill was enacted. So the week before the $8 billion bill was enacted, the IRS on its own and its own authority delayed certain filing and then payment dates, that due dates related to April 15th. So right now, if you have a due date, a tax due date on April 15th at the federal level, those are delayed until July 15th. Specifically, if you have a tax liability for a 2019 tax return that is due on April 15th, that is now due July 15th, both the filing and the payment. Similarly, if you have a 2020 first quarter estimate due on April 15th, that also is delayed until July 15th as well, without penalty. There were lots of questions around, what all did that guidance apply to, because it was a very specific April 15th date. And we have been waiting on more clarification around whether certain other types of tax return dates are going to be covered. And we believe in the next week or so that theirs is actually going to come out with more on that, to extend that relief to fiscal year taxpayers who probably don't even have an April 15th deadline. So I think we're just going to see more broadening of the filing relief provided by the IRS. An early version of the CARES Act, in fact, would have actually delayed not just the April 15th estimated tax due date, but also the June 15th, September 15th dates as well. So I think we're only going to see more broad-based relief. So it's a little odd, because if you take advantage of this relief, you end up having a Q2 estimated tax due on June 15th and a Q1 estimated tax due on July 15th. But we'll take the relief where you can get it. As I said, we're probably going to hear more around the NOL processing situation I mentioned. We did get a piece of guidance yesterday for those who operate as partnerships. One of the issues with the NOL carryback provision that it was intended to apply both to C corporations and pass-throughs was that under the partnership audit reforms that took place a few years ago under the Balanced Budget Amendment, or the Balanced Budget Act, partnerships who file amended returns cannot get refunds. They have to get refunds for that current year. So what that meant was a partnership that wanted to carry back an NOL under the CARES Act, even if they filed an amended return, would not get that refund until next year, until it filed the 2021 return. IRS provided guidance yesterday that relaxed that rule. So now partnerships will be eligible to get their refunds for the NOL carryback provision earlier. As I said, we are expecting other types of guidance to come out from the IRS over the next couple of weeks. I think they're going to be very active, even though they're all work from home. Things like opportunity zone, the 180-day deadline for opportunity zones being extended, or the normal deadline for 1031 exchanges to be extended as well. So as they identify more and more of these issues, then I think we're going to see more come out from the IRS, and it's really going to be important for everybody to kind of pay attention to what types of things come out, because if you remember from the financial crisis, some of the relief and the guidance that the IRS put out, while not as big as something like the CARES Act, were pretty significant, and so we would expect some of the activities of the IRS and Treasury to be more than just very kind of ministerial paperwork type of relief measures. So stay tuned there. I'm going to pause a moment because I think we have a couple questions I want to get to. So one question is, can I clarify the employee retention tax credit? Did I say that you can't take advantage of the SBA loan in combination with the credit? You can't double up on PPP, employee retention tax credit, but you could do EIDL. I believe that's the case. I have to go in and double check that because that's a little bit more specific than we've been talking about. So you may very well be correct. It's just something I would kind of follow up and take a look at. Have I heard any talk of the IRS adjusting 401k testing, specifically top-heavy requirements? I haven't heard anything along those lines, and that kind of raises a good point, which is as you all encounter different issues, particularly tax issues that arise from your businesses and kind of what's happening, we've almost been directly instructed by both staff on the Hill as well as at the IRS and Treasury to feed those into them because they are really genuinely looking for areas where they can actually provide meaningful relief. As somebody who worked up there at one point, you really are kind of in a bubble and you really do rely on people sending in stuff, ideas that in an environment like this that really do matter because you're always concerned that there's things that we're looking at that might not be as impactful as other things they may not be thinking about. So definitely engage with either your local members of Congress or directly up into Washington because I think right now they're definitely in listening mode, and to whatever extent Treasury and IRS can actually provide relief. They will definitely try to find a way to do that, even if they aren't clear if they have the authority to do so. They'll really be pushing the envelope as well. Another question came in. Let's see. So if you have temps working for you and count them in your number for the Payroll Protection Act, can you pay them the FFCRA related payments to help them, even if their employee staffing company does not qualify? Again, another really specific question. I'd have to kind of think on that and probably go back and look at the specifics. Definitely feel free to send me an email through the chamber if you want me to follow up with that. Because as we're getting more and more of these kind of granular questions, obviously we're trying to make sure we don't provide any incorrect information. And one thing I will point out, what's really unique about the CARES Act is the degree to which, and this question just kind of brought this to mind, I think I said it earlier, the degree and the breadth to which they expanded some of these programs beyond traditional employment relationships. So as I said, the SBA loan program, the 7A program, which I think normally wouldn't apply to self-employed individuals, independent contractors, nonprofits, it is available to those universes. Also, unemployment insurance, I don't think I'd mentioned, is also available to those folks. It's a little tricky in both cases how you report, as an independent contractor, what you were earning for the PPP program. So there's wrinkles there, but in principle, those programs are available to that broader universe. And of course, we're in an economy now where we have so many more gig workers and independent contractors that I think Congress is very mindful of making sure that everybody was covered, not just traditional employees. One other question: if you lay off your employees, so yes, this gets to the point about unemployment insurance being in some cases higher than what somebody might have been making while they were on the payroll. We've actually heard anecdotally from a couple companies, not necessarily in South Carolina, who are actually concerned that their employees might not return because they are making more on unemployment because of the significant increase. I can't really speak to that, whether they will have trouble bringing their employees back. Obviously, unemployment insurance is limited in time, so it doesn't go on forever. And I also think that, or maybe I'm hopeful that folks generally prefer to work, even if it's for a little bit less money, and not, have big gaps in their employment. That could become an issue later, particularly as the economy is coming back and maybe, it's not as easy to get hired as it has been for the last several years.